So when it comes to market crashes, how likely do you think it's going to be that there'll be a big crash in financial markets next year? And also, how do you prepare for them?
So the chance of it is higher than 2021, but it still wouldn't be my base case. I mean, my base case would be kind of choppy consolidation. I don't know if we're going to go to higher highs or if we're going to, just kind of stagnate. We could have a drawdown. Basically, when you have such a strong year, and then you have a pullback of fiscal monetary support, that can put some pressure on markets. And so a crash would not be my base case, but weaker market conditions would be. The ways to protect against it are to own some cash or bonds as a non-zero position so they can rebalance into the weakness of things you want to own, or to be long volatility or to have other specific hedges like some basically some puts or some long volatility plays that basically pay off if you get that downward volatility, that you can then use those gains to rebalance into, again, some of the assets you actually want to own. And so I think overall it is a time to be, somewhat defensive, which doesn't mean get out of everything that you want to own, but it means basically expect that it could happen so that you're not shocked if it happens and that you're ready to take advantage of it if it happens.
So I don't know if you follow Michael Burry from the film The Big Short on Twitter, but he recently has been very vocal saying everything is insanely overvalued. And then we have people like Cathie Wood saying she sees exponential growth coming in the markets over the coming years. So who is right?
So I would say somewhere in the middle. I think one of the biggest challenges with the growth camp, let's say the Cathie Woods camp, is that a couple things. One is we've had this kind of exponential growth from Moore's law, right? So semiconductors keep getting more and more efficient, and then software has absolutely blossomed for decades. The internet, and then mobile internet, and then all the applications we built, and so that's been a very exponential area of growth. And I think it's a mistake when people apply that logic to hardware, especially coming from an engineering background. I just know there's so many more constraints for things in the real world. And so hardware and things like that tend to not be as exponential as people suspect. I'm also watching the commodity shortages, kind of the structural shortages as it relates to copper, nickel, even oil and gas to some extent, compared to the estimates that they're going to be using in, say, 2030. And so I think we're going to be running into some, commodity constraints along the way to some of those visions of the future. And so I think that's a challenge. Also, I think a lot, especially earlier this year, a lot of like the ARC kind of Cathie Wood type of investments were very, very expensive. She had tremendous performance, partly because they went up very, very high, both in terms of growth, but also valuation on that growth. And so this year we've seen a big cooling off of valuation, even though ironically they're still high compared to, traditional valuation metrics. So they're still pricing in a tremendous amount of growth, even though it's perhaps less bubbly than it was before. So actually some of those names are perhaps more attractive now. I think some of the ARC growth stocks could do pretty well next year or 2 years. So I share some views with her, but I'm a lot more cautious about things that apply to hardware. And when it comes to Burry, I do think that most assets are bubble-like. I do think that the S&P 500 is unlikely to have great returns over, say, the next 10 years. I think some of the Nasdaq stocks, again, I think they're very, very expensive. I think bonds are overvalued. It kind of goes into the whole cash is trash thing. I think basically bonds, their yields are below the inflation rate. I think that if you hold bonds for the next 10 years, you're not likely to do very well in terms of purchasing power terms. Real estate in many countries is very, very expensive. In the US, it's less of a bubble than elsewhere, perhaps, but it's still expensive. And so I do think that there is, kind of an idea of an everything bubble. I think also the meme stocks and some of the cryptos have been very bubble-like, and that they're pro. In any given crypto cycle, 99% of that stuff ends up not really making it to the next cycle, right? It's kind of this, we throw everything at the wall and see what sticks, and there's only a small percentage of things that stick. So I think there will be things that 5 years from now are far, far more valuable than they are now. But I think a lot of them will likely not be. And so the areas that I would say are not bubbles are things like healthcare stocks, again, basically some of the value stocks, but specifically value sectors that are not being heavily disrupted, things that are just kind of cheap and not being heavily disrupted, and they just be kind of not exciting, right? So I think that that's the stuff that could kind of grind out better returns over a 5 to 10 year period compared to what people think. Whereas some of the really exciting stuff I think could stagnate. Now, I think that there's still exciting stuff, like whether it's Bitcoin or whether it's certain other things in the digital asset ecosystem. I still think they're going to do very well over a 10 year period, most likely. But I do think we're entering a period where people have to be pretty selective with what they own.